The 4% retirement rule has completely changed. We're going to cover what it means and why I personally don't follow it. Hey guys, it's Doug the Retirement Guy with all your monthly ETFs. And today we're going a little bit off kilter with the from ETFs, but basically an article that I was reading that they were talking about the 4% rule, how things have changed, how everyone's talking differently and all this. And I just started looking at it and saying, boy, why is it that I never followed this? Why I never, took interest into it is how the system really works against retirees. So we're going to cover it all today. So grab your favorite mug, fill it with your favorite beverage, and sit back and let's get ready to learn a little bit more about retirement life and that 4% rule. So, disclosure, this presentation is for educational purposes only. It's not financial, legal, or tax advice. Past performances do not guarantee future results. And if you need a financial advisor, always talk to a professional. Hey, before we go any farther, I got to tell you, the Retirement Made Easy Living on Dividends product line has been growing and it's phenomenal. You guys are supporting it. Thank you so much. Every one of these supports the channel. It allows us to keep doing the great videos, improving the videos, and doing more of the videos. Real simple. You can order yourself something real easy, an 11-ounce coffee mug, 15-ounce coffee mug. We have a travel mug. We have license plates. And we have a lot of different pieces. You can use the QR code, use the link down below. All of this helps support the channel so that we stay 100% unbiased across the board. We don't have advertisers promoting, telling us what to say or do. We are free to say what we want. If we like something, don't like something, we give you the honest, straightforward, almost like your grandmother would tell you. So thank you for your support. And if you're not part of it, don't be afraid. They're awesome mugs. Everyone's loved them. So the original rule was never a law, okay? This was a rule that came out about 1994. Bill Bengen's original research, he was an aero designer, engineer. He sat down and did a mathematical stress test of historical market cycles. Not a mandate, not a government statute, but it took off in the financial industry. It tested the historical scenario beginnings of 1926 to find the worst case scenarios. He targeted a sustainable retirement paycheck over 30-year horizon and focused on balancing equity growth against inflation against withdrawals. So I can actually say right now, this is where the problem starts to kick in, but I'm going to let that one sit for a minute. The reality now is that it's 4.15 actual historical safe max. So they've actually raised it 0.15%. So that 4% rule became a popular standard because it's easy to remember, even though the original research pointed to a slightly higher starting point. Okay? So the 4% rule, yeah, they dropped off to 0.015, but in reality, that was the actual number. Now, let me explain to you what I said earlier, what I was stopping for. The last line, focus on balancing equity growth against inflation against withdrawals. He was not focusing on income. He was focusing on growing your portfolio, making your portfolio get bigger and bigger. Inflation will increase and your withdrawals will reduce. So his whole thing was focused on grow your pot bigger and you can remove 4%. Isn't that what a lot of financial advisors tell you to do? Grow your pot, get bigger, and only remove 4% per year, and you'll be safe for the rest of your life. Well, how the traditional withdrawal methods work is real simple. You start off with this big pot of money, this anchor. The first year withdrawal from that anchor, from that pot, is basically is what your starting portfolio balance is chosen, that 4%. Okay? So you really are sitting here, year number one, our chart on the right is a 4% rule year one. So let's say you have a $500,000. You take out 4% of that, means you can live off of $20,000 annually, which means you're pulling out about $1,666 each and every month. Now, year two, you basically adjust your removal by inflation. Okay? So in the next few years, you're ignoring market fluctuations. You take the previous year's dollar and you adjust it solely by inflation to maintain your purchasing power. So a 3% inflation means you're going to times that $20,000 times 1.03, which means you're now allowed to take out $20,600, which is now $1,716 per paycheck. Sounds simple, right? Sounds easy. Everything works accordingly. Now, this is the one step I also never agreed with, was ignoring market fluctuations. You have to sell your growth to get your $20,000. Okay? So if markets go down, your pot's going to get smaller. If the markets go up, your pot's going to get bigger. But when it's down, you're selling. When it's up, you're selling. So when you're down, if you have it down for a couple years, you keep eating away, and you have less and less to regrow. It was the part that I never understood, but this is what the program was, and the financial advisors would tell me differently. So the opening of all this, what they've done lately, is they come back and said the 4% rule is now pushing 4.7. Why? So it's a direct comparison to the annual income of $500,000 portfolio. The traditional rule started off at 4%. We're now up to 4.7%. Because what they're saying is we've had great markets. Markets are growing more. You can take more money out. Well, this is a huge difference. It's a $3,500 difference in a 4.0 to a 4.7. So I started asking and said, well, which one really is it? Is it 4 or is it 4.7? This is where the 4% rule is changing. More and more people are saying 4% sounded great back then, 1990s. Now in the 2022, 23, 24, they're all saying, oh, we can take out more and more and more. So what changed in his research? Well, when you expand the test set, when you start opening up, there's a lot of things that have changed across the board, like the 7 asset classes. Bengen's updated work moves beyond the basic stocks and bonds to include highly diversified portfolio structure. So we're looking at large cap stocks, we're looking at small cap stocks, mid caps, international, government bonds, treasury notes. There's a lot of different pieces that have changed. There's new things that have come to the marketplace. And there's a lot of different pieces of the puzzle now, which is resulting that 4.7 is actually a safe max in direct correlation with everything that's really changing through. So what does that 4.7 really mean now on a $500,000 portfolio? Well, like I said, it's a $23,500 annual income if you're starting off with. It makes a big difference. That's adding like $292 a month to your withdrawals. So that $3,500 a year could represent, like I said, $292 a month could represent your utility bills. It could cover an auto costs, groceries, lifestyles. It could be a meaningful change, but it's not magic. You're just pulling more of your own money back out. So the other side of it is where we start seeing the arguments that they're now saying the Bengen 4.7 rule and Morningstar's still at 3.9. Who's right? Who's wrong? We're now having everyone argue, and you've seen this on many of the big names out there. You go up to 8%, you go 7%, you go 6%. We're all just throwing numbers at the wall of saying how much money you can withdraw if you continue following the same system. So that 4.7 identifies the historical worst case style ceiling using expanded diversified 7 asset class portfolio. So what they're saying is the change came into is how the market has changed, how we've gone to different pieces to the market. Morningstar still is at 3.9, aiming for a steady inflationary adjustment spending over 30 years with a 90% probability that the money is remaining. And then the flexible spending designs, the variable, which you hear a lot of people talk about, is very flexible. It supports potential higher starting rates in exchange for dynamic adjustments in specific trade-offs during market volatility. Well, there's another one that I read too, is that variable is when you're starting off, you're going to spend more because you're going to be in your go-go years. You're going to be traveling. You're going to be doing all the things you wanted to do. And then you go into your slow-go years. So you slow down. You're not spending as much. That allows your account to rebuild, recapture. And then when you get into your no-go years, then you don't need much to live. So your withdrawals become even less and less. So there's a lot of different ways that they're coming back with all this. So why you shouldn't just start immediately with 4.7 is because, one, you don't know the length of your retirement. You don't know if you're playing for 20 years, 40 years. You don't know. And then your asset mix, you have to rely on reliable, specific 7 assets of your portfolio, not just a standard 60-40 mix anymore. You got to know what you're getting into. Then you got to worry about inflation. You got to worry about the success probability, the spending rigidity. You got to stay within these budgets or you're going to have this issue. So there's a lot of pieces to this puzzle when you sit down and say, well, should I be 4? Should I be 4.7? Where I'm at. But I'm not trying to scare anybody or say anything, against it. But this is some of the things that you need to understand. You have to have a complete plan. That's the first thing. You have to have a complete plan when you're starting to do the 4, the 4.7, the 3.9. It's confusing across the board. So this is how they said the 4% rule has changed because primarily of those asset mix changes. So what is the real problem with the withdrawal rule? Well, you're really coming into one thing, is you're really just pulling money from your accumulated pile. Okay? So I'm going to put it in really simple terms here. You built a giant pile of money, and then you're just going to pull money off as you go and not worry about your investments, not worry about what you put into. Now, they tell you to put it into heavy growth and heavy pieces, but that's what you're putting it into. So the retirement's number one concern is outliving their money. You talk to most people like I do. I talk to so many retirees and different people either getting ready for retirement or into retirement. And the number one rule everyone tells me is I'm worried about outliving my money. When I am old and in 80s and 90s, I have no money to live on. How am I going to live? I get worried about that. So I've always been a suggested of building the 3-bucket portfolio. And I'll explain to you why it's different from the 4% rule. The 3-bucket system basically tells your money what to do. You give your money specific jobs. It goes into what we classify as buckets. You have a foundation bucket, which is the stability, liquidity, and emergency runaway funds. You got income bucket, which is generating your income to pay those bills. So it's like paying that 4% rule that you use. This is where the income comes from. And you still have a bucket for growing your money accordingly. Now, I wrote a book on this. Now, I'm not this is not a video to promote or advertise, but I wrote a book on this entire subject because so many people keep asking me, explain it again. And I thought it was a great piece to it. Now we have this on our website. You can get that, or you can get it at Amazon. They do it with the Amazon Direct Books, or you can do Kindle, however you want to do it. You can get the books, but it really breaks down that living off of those dividends is totally different from that 4% rule. So let me briefly go through this, because I'll share it all with you. Is the foundation bucket protects you for today. It gives you that immediate liquidity. Okay, it's liquidity. It's the cash that you need to pay those bills. Okay, it's the sequence risks. So it reduces the need to sell your growth assets. The 4% rule, you have to sell your assets to get your 4%. While this one here sets it up where you don't need to sell your assets. You have money in emergency. You have money coming in across the board. Your growth bucket is for tomorrow. You're investing a portion of your pile of money into a growth bucket that you're looking to appreciate your money in 5, 10, 15 years that will help pay for tomorrow's packaging. Okay, so it's a long appreciation. Capturing the growth market in your 80s and 90s, is still part of this whole thing. It's an inflationary hedge. You're growing for what inflation could be. So you just constantly, and then it's the other big thing that people always say, I want to see my portfolio grow. I want to see it getting bigger. Well, it gives you that ability. And then our income bucket, which is going to pay for your living today and tomorrow and down the road. So your building blocks is dividend, ETFs, equity income, option incomes. You're going to have some bonds, some treasuries, a lot of different things to it. Now, the one thing I always want to tell people is the distribution yield is not the same thing as suitable withdrawal rates. Okay, so I got to put the clarity out there. That 4% that they're talking about is a withdrawal from your portfolio. Well, the rates you're going to talk here, we're going to talk some yield when you talk buckets, but that's not the same as 4%. So it's a little confusing that people get into first. That's why I explain it all really in the book. But let me show you something, a comparison, what happens here. Let's say you have $500,000 in your portfolio. That pile of money I talk about, it's $500,000. So what we call is your retirement income gap. Your total spending per month is $5,000. Social Security, fixed incomes, whatever you get, let's say it equals out to be $3,000. Your portfolio gap, your income gap, is $2,000. Very common out in today's market, which that means you'd have $24,000 a year that you have to withdraw from your portfolio. So if you take your portfolio of $500,000, divide it into the $24,000 that you need, you basically have a 4.8 efficiency rate, which means 4.8% of your portfolio needs to be sold off to generate cash to pay your living expenses. Okay? They're telling you the new rule is 4.7. You're a 0.1 off from their new rule. You're 0.8 different from the 4% original rule. So a financial advisor will tell you right off the bat, we need to grow your $500,000 to a bigger number. Or you have to cut your expenditures. You have to reduce what you're doing. This is the hardcore facts that they will tell you. And they'll be questioning, we could probably make it, but I'd really suggest you do this, or we're going to have to invest aggressively here or there, because they're above the 4% rule. Now, when we throw the 3-bucket system in, this is what really gets unique. I didn't change anything, so I used the same exact screen so I could show you the difference between the two. Your income, your spending is still $5,000. Your Social Security is still $3,000. Your gap, your income gap is still $2,000 and $24,000. What I did differently is take a look. Your $24,000 is now divided by $375,000. Because I told every dollar to do something, your $500,000, the extra money is in your foundation fund and your growth fund doing other work. I'm saying $375,000 of your money needs to go to work to generate 6.4% return rate. Okay? So an average fund in this portfolio, this style, generates about 8%. So I'm already almost 1.5 percentage points above what you need in generation of money. And when I say me, it's the three bucket system that we talk about. Generates more income to cover your 24 than selling off your portfolio pile of money. Because you put your money to work. So same portfolio, different retirement problems, different answers. I'm not, like I said, I don't follow it. I don't follow the 4% rule because I disagreed with a lot of it and I saw better things out there. And the first one is, let's take household A with that $500,000 portfolio. We're not going to change that number. But let's say their income needs, their income gap is $15,000 a year. Well, they're below that 3%. And they're well below the 3%. Now they're well below the 4%. So they could use, household A could just use the standard program if they wanted to and not change anything at all. But household B, who needs $45,000 of income, is at 9%. Maybe they're not collecting Social Security. Maybe they're not, maybe they're overspending, to be honest with you. But we're still at a 9%. That's a critical risk. No financial advisor will sit down with them and say, you can retire comfortably, blah. They're going to say, we got to increase your portfolio. You got to work a few extra more years. And my answer to it is, if you're trying to use the bucket system, we're only 1% point high. It just changes the whole picture when you're dealing with this. So why buckets can help during the bear markets, bull markets? It's the number one thing is what makes the bucket system work is the setup, is that you tell every dollar to do something. Every dollar has to go to work. While the 4% rule is a stacked pile of money sitting in the corner collecting dust, invested to grow, but not work to generate income. It's a big difference. So what the new research enforces this, the shift of systems. Bengen updating to 4.7 wasn't magic. It was diversification. By expanding from 4 to 7 different asset classes, the research shows that the coordinated engine outperforming a single speed motor. The 3-bucket system shows it even more. If you have just pure point growth, which again, I'm not knocking financial advisors. I'm not trying to knock it. I'm just trying to say, guys, look at it a different way, which is why so many of my viewers out there come back and comment to me, Doug, you opened my eyes up. So I'm not trying to be a preacher. I'm not trying to say, I'm just like, wow, what's different here? Financial advisors are always telling you grow, grow, grow. That's how they make money. And we're saying, hey, you need some growth, but you ever think about having some reliable income coming in and having some stability in not to have to worry about markets, and you have some liquidity for your emergencies, and your inflation protection is already pre-built in? So what they're doing now and saying, hey, we need to change the 4% system, while the bucket system has continued on. That's not something I created. This has been out there. It's just a unique way that people are starting to use a better tool set to build the same answer. So is the 4% rule dead? No, not at all. It's evolving. It's changing. The 4% remains that critical starting point. It's a retirement math that everyone can understand and figure into it. But just like everything we deal with, it gets better and better with time. Okay? It's a benchmark stress test. It's a simplified proxy of history safety, and it's a foundation for dynamic adjustments. While retirement durations, you are all over the place. You don't know how long you're going to retire. I've already been retired for over 10 years. And I do chuckle and laugh at some of the YouTube people out there that, are in they're not even retired yet. They're in their 20s and 30s and they're telling you how they retire. Well, I've done this for 10 years now. I've lived on dividends for over 10 years. So the retirement duration, you don't know where it's at. That's what I'm trying to tell you. I have. Healthcare costs, taxes, healthcare costs. We did a video on that already. We did a video on healthcare, how to get the healthcare situation taken care of. So I'm not trying to say I'm perfect and right. I'm just saying I've lived it. I've made mistakes. I've come back from it. And I just realized that the 4% is a great starting point to work from, but there's better systems out there. So the biggest thing I come across with, I'm going to share with you to learn, is the number that matters the most. And that calculating your personal portfolio fund income gap. So many people, when I do my one-on-one phone calls and Zoom calls and stuff like that, is the number one question I always ask is, what's your income gap? And you guys are starting to learn. We're starting to see some more better things coming out that they're starting to lower the income gap. What's your annual lifestyle expense? What's your Social Security benefits? What's your pensions or fixed annuities or reliable income sources? You deduct all of that from your annual lifestyle expenditures, and then you know your income gap number. Okay? Then you take your portfolio fund, you divide it into that number to give you what your targeted return number really is. It's that simple. So a $500,000 portfolio recap. This is why I tell you on the channel all the time, it's not about, the size of that pot, because we've shown where people can retire with a heck of a lot less money. It's always easier with a heck of a lot more money. But the traditional rule is at 4%, you're talking $20,000 a year is what you can spend. Bumping it to 4.7 puts you at 23.5. The bucket system gives you a bigger difference across the board. So this is the recap what's happening right now with the ruling that they came out, with the whole announcement that Bengen came up with, that they went to 4.7. Makes some huge difference between it. But you're using old technology versus new. So the final implementation checklist: how much income do I actually need to maintain my lifestyle? What protects my near-term bills during market crashes? Are distributions supported by total return and not stability of NAV? How long my retirement last? How much comes from Social Security, pensions, and annuities? What keeps growing to provide inflation protection? How much flexibility do I have in annual spending? And have I calculated my specific portfolio income gap? These are all the questions I will tell you straight out that you need to ask a financial advisor. You need to ask the person in the mirror. You need to go around and say, hey, where are we at in our life expectancy? These are questions I ask everybody when I have my one-on-one calls. This is the important piece of it all. Guys, in closing, is you need to build a retirement system, not a retirement system of withdrawing from your big pot of money. It does leave you questioning, do I have enough money in there? But if you build a complete system, like a 3-bucket system, you already have a plan of attack across the board, which is that foundation, the income, and the growth. A goal is not simply the biggest pile of money. The goal in the retirement system lets every dollar do its job. Let me know your comments. Let me know your thoughts of all this. Leave a comment down below. I try to do these things outside of just doing ETFs all the time, trying to help retirees understand the future down the road. Let me know. And if you like what we're doing, hit that like button and definitely check out the Sporting channel. We appreciate it, and we'll catch you at the next video.